Hopefully you got to hear a bit of that conversation. And what are you making of these latest developments where we're set to see management of AMCON being announced hopefully by Tuesday, and more progress being announced with regards to recapitalization of some of Nigeria's failed banks?
Hi, Alishia. I think it's actually a positive development. And in my view, I think if we see it as soon as possible, then it would actually be good for the banks. I think so far the market has been responding positively to it. I think the positive development around Oceanic Bank also has been really well embraced by the market. And I think if AMCON is set, if the board of AMCON is announced, and once we start seeing deals, then I think we'll see more positive flow from the market. And obviously we'd actually get to closure on the resolution of most of the in the banking sector as a whole.
Of course.
But I think it's actually going to be a very good development for the banking sector.
Of course, it's just Union Bank that's announced that it's in talks with a potential bidder. We don't know quite yet just who that bidder is likely to be, but we know that Access Bank is in a very big position where the market is largely expecting this player to be very big on that M&A front and pushing themselves into the top tier via M&A activity. What's your view on Access Bank right now?
We actually have a positive view on Access Bank. Access Bank released its result yesterday and it was quite strong and positive. The bank beat our expectation in terms of PBT, even though gross earnings we saw a decline in gross earnings. But I think overall the result has been positive. Capital adequacy ratio has been quite strong. NPL has also improved. NPL ratio has also improved as well. And I think what we've seen so far is that the bank's performance has been improving. We've seen an increase in momentum from half year up until now. I think if the bank is able to participate in the M&A, obviously it will be able to improve its market share.
That is, of course, key at this stage, Muyiwa, because the big question out there is what happens if they don't engage in a merger and acquisition activity. Many can't really see where they're going to be going from here.
In my view, I feel Access Bank can still stand strong if it doesn't participate in an M&A. If you look at GT Bank, that is one of the tier 1 banks, in terms of branch network, it's actually not one of the largest, but its balance sheet size is still quite large. So I think if Access Bank doesn't increase its market share through M&A, it can still grow organically, even though it might be quite expensive. But I think if it has a very robust and efficient IT system, if it can improve its customer service network, it will be able to grow retail customers, which is access to cheap deposit, and with that, to be able to create more risk assets. So I think not being able to participate in M&A, won't really. I think if Access Bank manages, Access Bank can still grow organically, but it might just be expensive. But I don't think it will be the end for Access Bank if it doesn't participate in this current M&A system.
Well, along with Access Bank, we've got Diamond Bank also expected to outperform amongst the tier 2 banks. Unity Bank, in the meantime, expected to outperform when it comes to the rescued banks in the country, since they successfully raised capital, which is being expected to be deployed to grow the business moving forward. Your view on Unity Bank?
I think Unity Bank right now will be able to play well in the northern region because it's actually been very strong right there. And I think the fact that it was able to grow, to increase its capital within the time it applied for it, while Wema Bank is still struggling. Right now, Wema Bank has asked for a longer tenure to grow it, to increase its capital. And I think Unity Bank is well placed and will be able to grow its risk assets. And I think performance of Unity Bank has been quite strong. We saw half-year numbers strong at 11 billion PAT. So I think Unity Bank would be able to play well right now and should be able to outperform. But I think a Union Bank might still do better than Unity Bank, and Oceanic and Intercontinental as well, if it's well managed, will be able to even outperform Unity Bank, because in terms of scale, those banks are still much larger and still have a few tier 1 corporates that will be able to generate stable and steady income from.
Well, let's look at it flows-wise, because local versus foreign, what are we looking at there? On the surface, it seems like it's international clients that are the ones that are happy to pick up stock across the board.
I think, like you said, if we look at it both from a local and international scale, the international guys are interested in the strong banks right now. They are picking up banks like Diamond Bank, picking up Access Bank, looking at GT and First Bank, while the local guys are more active. That's the retail investors right now are more active with the troubled banks, and with activities around Oceanic Bank, around Unity Bank, around Union Bank has really been done mainly by the local investors, while institutional, local and foreign investors have been more active in the stronger names, because there's actually been more clarity in that, and it's not as risky as playing in the troubled names where we're really not sure where they will be. But I think so far news flow from the CBN, from the legal system as well, has been quite positive for the troubled banks. I think that's why we've seen an increase in momentum in share price. And like you mentioned earlier, they've actually been performing quite well, and they've been keeping the banking sector strong.
Well, overall, I mean, with technical indicators suggesting that the all-share index is nudging into overbought territory, what are you making of current valuations, Muyiwa, relative to the fundamentals? Because that's, to a large extent, what will determine whether any upturn on this market is going to be sustainable.
In my view, valuations are still strong, because if you look at most of the banks on price-to-book basis, the tier 2 names are all trading at a discount to book right now. They're all trading at an average of about 0.8 times. The banking sector within our coverage, we cover about 14 banks, and they're all trading at about 0.9 times book value. So in terms of valuations, they're all still quite attractive, and most of them are actually trading at an average of about 30% to our target price for the end of the year. So I think in terms of valuations, we can still see value in them. If you look at the performance so far for the Q3, the numbers have been quite strong, even though ROEs currently is at an average of 11%, but we still see banks like GT Bank, Zenith Bank trading with ROEs at 17% and also 12%. So I think in terms of valuation, there's still value in the banks. They've all come up significantly, and most book values are still quite strong. And so I think that's where we should be looking at, and the little, shall I say, the little appreciation we've seen so far shouldn't really deter investors from investing in these stocks, because we can still see value. And we expect loan growth to kick in from next year once the banking reforms is fully in place, and where banks are much more comfortable
where
to
we've
take
been
on
highlighting, Muyiwa, all the positives. I mean, First City Monument Bank, not such a good set of numbers coming out of that group. I mean, profits, even though a huge jump coming through there, compared to your profit before tax expectations, still 50% below what you were expecting to see out of that group.
Yes, we weren't really impressed with FCMB's numbers, and I think one major challenge the bank still has is costs. Cost-to-income ratio is still quite high. It's about 80%, and what we had actually expected that there would be a decline, but considering the fact that gross earnings, we saw a decline in gross earnings, and I think even though if you look at absolute numbers, there's been a decline in operating costs, but because there was also a huge decline in gross earnings as well compared to the cost-to-income ratio has been high. But I think in terms of NPLs, we've seen an improvement in NPLs. NPLs has improved to 7% from 9%, and the bank has actually been able to grow its loan book as well by 30%, even though the bulk of it was done in the last month of the quarter. So we'd expect that income from that would kick in in Q4. So I think even though we haven't really been quite impressed with the numbers, but there's actually been an improvement in its numbers compared to where the bank was sitting in half year. But I think overall, for the bank and for the sector, we've actually seen a strong improvement, even though the results have actually been mixed. We've been seeing numbers below expectation, while we've actually seen a few above our expectation. But I think overall, we've seen positive momentum. Asset quality as a whole has actually improved significantly. Cost-to-income ratio has reduced, but not at the level at which we expect it to, because if you consider the fact that inflation has also increased as well to about 14%, if you factor that in, you'd see that there's actually been an improvement in the numbers, and they've been more efficient than
Well, we're going to have to leave it there, unfortunately. Thanks so much.